profit maximization, and earnings per share. So also under the fourth section, we look at corporate objectives and the influence of stakeholders. Likewise, we talk about financial management in not-for-profit organization. Likewise, the economic environment of business. So tonight, we're talking about financial markets and institutions. Financial markets and institutions. I believe the word market is not a new thing to us. Those days, when they asked us to define markets as a place where buying and selling take place. But today, it has gone beyond that. You can sit at the comfort of your house and trade with someone in another state via the internet, e-commerce, and the rest of it. So, so also institutions. Institutions are various bodies whereby financial uh, are various bodies whereby financial transactions, security exchange, insurance that support the operations of organizations take place. So we have various forms of institution. The bank is one, Nigerian Stock Exchange is one, the insurance company, uh, various forms of institution in under the financial system. Now, when we bring all this together, the financial market and institution, they make up what is termed as financial system. Financial system. So everything financial financial institution, financial securities, treasury functions, capital markets, money markets, stock markets, and corporate bond, they all make up financial system. This now leads us to the definition of financial system. If you are asked to talk about the Nigerian financial system in your exams, what will you say? To me, I will define financial system. I will define financial system as sets of institutions, markets, instruments, rules, and procedures that facilitate the flow of funds in an economy. So financial system does not operate like that. There are rules and regulations that guides the operations in the financial system. So the financial system includes markets and various financial intermediaries that help transfer financial assets, real assets, financial risk in various forms from one, I would say, entity to another, or from one point to another. So this transfer take place whenever a party exchange one asset or financial contract for another. So the asset and contract that market participants trade in can include things like bonds, shares, currencies. It can include forward contracts, future contracts. It can also include option contracts, and likewise, it can include swap contracts and so on and so forth. So most of what we've mentioned under the financial system are what we're going to be looking at as we go on in the course of this our class for financial management. And to get to a point, we'll be calculating how to hedge against risk that might befall an organization. When you have 20 naira today, in order for you to guide against the risk of paying more in terms of that 20 naira tomorrow, you can quickly hedge against the rising and falling of interest rates that might affect your business or your contract that you wish to execute in the nearest future. So you can quickly guide against risks by hedging. And there are various ways of doing that through forward contracts, future contracts, option contracts, swap contracts, and the rest of it. So all these are topics on their own where you'll be converting currency of one country to another. If Nigeria trade with Ghana, what will be the exchange rate? What will be the value of naira that you need to get to convert to Ghana cedis. So all these are special topics under financial management that we'll be looking at. Now, the financial system is an umbrella term covering the following: that is financial markets, financial institutions, and financial securities. When you talk about financial markets, what are those markets? The stock exchange market, money markets, and so on and so forth. Capital markets, likewise. Then financial institutions, there are institutions that intermediate between surplus fund and deficit fund. They try to see who are those people that have money. Let's bring them together. The little they have, when we put them together, we can now lend to those that need the money. So they perform intermediary roles between the surplus aspect of the economy and the deficit aspect of the economy. Also, we have financial securities, which include mortgage, bonds, bills, and equity shares. So the financial system is an umbrella term for every activity that takes place here. So that is talking about the financial system. Talking about the financial system. Now, the financial system performs the following functions. What are those functions? One of the functions is that they help to channel funds from lenders to borrowers. Now, let me ask a question. Who is a lender? Who is a borrower? Sometimes we misinterpret these English words. Who is a lender? Who is a borrower? Yes, yes. Can we speak, please?
Yeah, the lender is giver, while the borrower is receiver.
All right, sir. You want
Oh
to say
yeah,
something, sir?
yeah. Lender is the person that have the surplus now who can give. The
Yes, sir.
borrower is one who needs the money, who doesn't have.
Yes. So that is it. You're all correct. So the function of the role of the financial systems include channeling of funds from lenders to borrowers. That is, when you have excess money, what will you do? You put in the bank. Yes. Now the bank, in order to generate income from your money, they give out to those that don't have, and in return they generate interest. So that is one of the function of financial institutions of the financial system. And also they provide a mechanism for payment through direct debits, check clearing system, and the rest of it. So at the time you want to clear an instrument, a check, you want to convert a currency to another, the financial system performs this function. By the time you have a foreign currency and you want to convert, the the point of you converting it can either be you going to the bank or going to the bureau de change to do that. So these are some of the functions of the financial system. And also they create liquidity and money. How do they create liquidity and money? Can somebody speak to this? So I've stated that before. How do they create liquidity and money? You don't have bankers here.
How they create liquidity, I'm not a banker, but creating how they create liquidity and money is through that lending of money now, giving out money
Yes,
to people that are in need.
yes. So that is how they create liquidity and money. They create liquidity by harnessing surplus funds from those that have and give to those that are in need of it. So in return, they generate certain interest, and in that way, they they create money, they create liquidity. Yes, and more so as part of their as part of the financial system function is yes, as part of the functions of financial statements is that they provide financial services such as insurance and pensions. Yes, you want to guide against risk, you quickly run to the insurance company. If you want to save for your retirement period, you go to the pension fund. Yes, to do that. So in that way, they can give you advice on various insurance policy available at your age. What kind of insurance cover can you take? It gets to a point, maybe when you are 70, 75, the insurance company cannot grant you life insurance because at that point, the risk of one uh, leaving the earth is very high. So most insurance policy does not cover certain people within certain age brackets. So they provide these services. The financial system provides these services, and also they offers facilities to manage investment portfolio, which is to hedge risk. Now, what is portfolio? What is portfolio? Yes, if you have a finance background, you will know what portfolio is. So, what is portfolio? Can anybody help me? Portfolio. Yes, yes. Let's make it interactive. You all know all these things. So, somebody should speak to that. What is portfolio? These are some of the things we'll be talking about in the course of this class. So, what is portfolio? Somebody should speak. Hope your attention is in this class.
Our attention is there.
Okay, all right. So, what is
Now
portfolio?
with you, sir.
All right. So, can you speak? You heard the word portfolio before. So, Chidima,
Portfolio is just the total, like the collections of the assets and the investments, everything together. That's the portfolio.
yeah, it's very correct. So, when you have different investments, like Dangote is a very good example of an investor with various forms of securities or investments that make up portfolio. Now, a portfolio, as I said, is a collection of financial assets held by an individual, institution, or fund. When you put all these your assets together, they make up portfolio. Why portfolio? Portfolio is to guide against risk. Now, I usually make use of this example when teaching SFM class that when you visit this malam selling tea, you discover that they have various combinations of stock in their wear. Now, some of them have even developed to the point of selling soft drinks. Some of them have developed to the point of preparing indomies for, for those in need of it. So what they are doing is that they are spreading their risk. During the hot period, there should be more sales for soft drinks, chilled one. During the cold period, there should be more sales for hot tea. And so many of them are even engaged in doing POS business, trying to do so many things that once this aspect is not yielding income, this aspect should help cover up. So portfolio is a collection of financial assets. The essence of it is for you to guide against risk, because when you put all your eggs in one basket, when that business that you've put all your egg is suffering and you don't have any other alternative, it will not be good. So it's very important that you spread your investment. So the collection of these investments, this financial asset, is what is termed
Bring them and they come.
as portfolio. Is what is termed as portfolio, and that is done through hedging, through risk management. So it's a very key topic that we must know even as we go ahead in our studies of financial management. Now, we have what we call the financial market. The financial market is a market where surplus spending, let me put it as surplus spending units, of individuals, groups, or organizations operating within the economy that have excess funds above their immediate needs, supply funds to those in need of them. So, in more simple terms, I would say a financial market is a place where short term and long term funds are borrowed. So, a financial market, based on the slide I said, is a marketplace where buyers and sellers trade financial assets such as stocks, bonds, currency derivatives, and other instruments. So, it serves as a platform that facilitates the allocation of capital and the transfer of risk between participants like investors, companies, governments, and institutions. So, financial markets is not just a place, it can be collections of people on via the e-commerce. Yes, there can be a platform where people trade with each other and might not be just a physical place. So let's take note that a financial market is a market where surplus spending units of individuals, groups, organizations operating within the economy that have access to much funds above their immediate need. They have much resources, they don't even need it now. So what they do is to invest them, And in investing them, they can take them to the bank, to financial houses for such investments to yield returns in future. Still on the role of financial markets, still on the role of financial markets. The basic rule of financial markets is intermediary function between surplus and deficit units. That is, the intermediate between those that have and those that are in need of the surplus in the economy. So, intermediary function between surplus and deficit units. In any economy, household, businesses, and government experience periods of surplus, that is excess funds, and deficit need of funds at different times. So in some period, it can be your peak period. In certain period, it can be a season of droughts. So at a point, you might be the one giving out money because you have excess. At another point, you might be the one that is in need of money. So financial market acts as a linking mechanism, connecting those who have surplus funds with those who need funds. So we have the deficit unit, those in need of funds. We have the surplus unit, those that supply funds. We are together. Are we together?
Yes, we are following.
Yes, sir.
All right. This is story. I want us to finish all these stories. Let's move to calculation. So that's but all these parts we're talking about, please try and study them, relate them to what is happening in the economy. Then the first time the exam is coming up, they can decide to bring up questions from this area. And I sent some theory questions over time. I don't know if anybody have solved it. So on my own, I'll forward the answers to the platform of those questions so that you can read and have more knowledge about those questions I've sent to the platform. So still on the role of financial markets, they facilitate investment of surplus funds. They facilitate investment of surplus funds. That's excess money. How do we make use of it? Should we just keep it as savings in a fixed deposit account? Or are there more opportunities, more options that when we put in the surplus fund, we will be able to make more money rather than putting it in a fixed deposit account? So the role of financial markets, as a financial manager, you are expected to be able to advise the organization on how to make use of their excess funds in relation to retained earnings. How do we put in this excess fund into more business opportunities so that in the long run, the shareholders can always smile home because their investment is yielding high return. So as a financial manager, you might be asking why all this in financial management. You must know how the financial market operates as a financial manager. You must not be a novice, and that is why this is coming. So if you've not been watching business news on the various channels in our country, even abroad, try and listen to business news and see what is happening in the financial sector, because they can come up with certain trends in the economy as a question. So by the time you are just glued to your book and you don't follow business news, it will not be that okay. So it's good you follow business news on the various channels that you have on your TV sets. At least it's broadening your horizon. Yes, when they're analyzing issues of stock, closing of the stock at the day, what is the yardstick? What is the parameter? Which organization is the highest loser? Which organization is make the highest gain as at the end of the close of business day? So all this knowledge, they are also very key. As a chartered accountant, you can be employed in a media house to do analysis of organizations' financial statements, to do analysis of the trend in the economy. So that is why this is important. So as part of the role of financial management, these financial markets helps facilitate investment of surplus funds into area that will yield high return in the near future. So surplus units such as household, firms or government with extra cash seek to invest deposits or lend these funds. So they do this with the aim of earning a return on investment, such as interest, dividend, or capital gain. So this is the motive of you investing your excess fund so that in the near future, you have more dividend, you have increase in your capital gain and the rest of it. Still on the role of financial market, they help in providing access to borrowing for deficit units. Yes, you might be a financial manager in an organization, and as a financial manager, you've been saddled with the responsibility of thinking how the organization can source for funds to invest in viable ventures. So you are required to provide advice on the best source of financing. Is it equity? Is it debt? Debt is a cheap source of finance because there is interest or tax savings on it. There is tax savings on debt, while equity is the reverse. It is free from tax. So, and the equity owners will want to generate more returns because by the time you introduce debt, you are putting them into more risk. So these are some of the core forms of calculations that as we go ahead, we'll be seeing what we call the capital structure of an organization. What is the component of the capital structure of an organization? Is it just equity? Is it just debt? Now, is it both equity? Is it debt? What is the proportion of equity to debt? That is the ratio. Is the ratio of equity to debt 70%, 70 ratio 30? All this we'll be looking at. And you must know that an organization that is financed solely by equity is termed as ungeared company, while those that are financed by both equity and and debt, they are termed as geared company. So these are some of the terms we're making use of. So as part of the role of financial markets, they help to provide access to borrowing for deficit units. As a financial manager, you can run to the financial market and seek what are the best way I can source for fund in order for my organization to invest in viable future. And that leads to we calculating issues of average accounting rate of return, we calculating uh, return on equity, return on investment. This leads to you calculating profitability index. All this leads to you calculating NPV. This leads to you calculating internal rate of return. So all these forms of calculation are still what we'll be looking at, because as a financial manager, you should be able to tell if I should get a loan based on my inflow and based on my outflow, at what point will I be able to pay back? Will it be of great benefits to the organization or to be a great loss? So you must weigh various options and give quality advice to the organization. So that is part of the role of a financial manager. And as this exam comes, you'll be served with questions that involve making calculations that warrant you to advise your board of directors. So begin to open up your mind to some of these things, yes, as they come. So also, as part of the role of financial market, they aid in efficient allocation of financial resources. Yes, they aid in efficient allocation of financial resources. They give you advice on how to use your fund, on the best form of stock you are to invest in, on the best form of business opportunities you are to invest in. So efficient allocation of financial resources. So financial market ensures that funds flow from where they are in excess to where they are needed most. So this supports optimal resource allocation within the economy. The optimal resource allocation involves you putting your excess fund in the best, or using your excess fund in the best possible way that will yield the expected return, that will yield the best return. So also, the financial markets, they facilitate economic growth. They facilitate economic growth. Can somebody speak to this? How do they do this?
As they as they support optimal resource allocation from deficit and from surplus areas to the deficit area, it aids economic growth because those deficit areas will grow in profit, and it will yield more returns for them, and it will also um, yield interest for the people that lend, for the lenders also. So it's a win-win for the both parties. So economic growth and development will
Yes, very
come.
thank you. Okay. Right on, please.
No, that's all.
Okay, now I need to ask a question. How do you measure economic growth? How do you measure economic growth? We've talked about that in one of our classes. How do we measure economic growth? We measure economic growth.
Production level, okay.
Right on,
Production
sir.
level and production, okay, GDP, yeah, production level and employment level of that economy.
Yes, very good. So economic growth is the increase in the value of goods and services produced by an economy over time. So it is measured by the rise in the country's gross domestic product, GDP. So you look at the percentage increase in real GDP, and also you look at the time frame. These are metrics you use, and it can be annually, it can be quarterly. So when you listen to business news, you hear at some point they will tell you that inflation has reduced in Nigeria by certain percentage. But people want to ask, are we feeling it in our daily livelihood that inflation has reduced in the economy and you're still buying certain goods at high price? So one of the role of financial markets in conjunction with the government is that they help in facilitating economic growth by enabling investment and borrowing. So financial markets stimulates production, innovation, and employment, thereby driving economic growth. So by the time you are gainfully employed, you have money to buy what is being produced in the economy. By the time you are gainfully employed, you'll be able to think well, yes, and render quality service to your organization. So this is also part of the function or the role of financial market. So please, in your notes, when you read, you can make summary of some of these things. And as you read some of these theory, you can even use coding to try to remember certain things. Yes, sometimes when you use coding, the role of financial markets, when you remember economic growth, you can use E for economic growth, you can use this, so that in the example, when you see questions in that light, you will be able to bring up points from that coding of those big write-ups, And also, as part of the role of financial market, they help in providing liquidity and risk management. Yes, we have risk managers, we have the actuaries. They are those that evaluate risk. Is a course under business administration, and I think in some schools they are offering it as a course on its own now. That when you evaluate risk, the actuaries are those that are involved in doing that. So they also perform that role in the financial market by providing liquidity and risk management. So financial market offers mechanism for liquidity, allowing participants to buy and sell instruments easily. So they also enable risk management through instruments like derivatives. We have what we call derivative instruments. So instead of you collecting money from a bank, you can decide that a derivative instrument should be used. We'll see that as we move ahead in the course of our class now. Derivative instrument, what it entails, and the various examples of derivative instruments. So also, we have the financial markets. Financial markets can be divided into different types depending on the product being issued, bought, or sold. So there are various classifications of financial markets. We briefly talked about this in the last class. We have the capital market, we have the money market, we have the commodity market, we have the derivative market, we have insurance market, we have foreign exchange market. Now, under capital markets, we often have the primary and secondary markets, and also under the money markets, we have primary and secondary markets. So the capital market consists of stock market for shares and bond market. Yes, bond market. Now, what is a bond? And somebody help so that we'll not just what is bond? Yes, these are terms that you must know. As we go ahead in our studies, there is what we call convertible bond. So what is bond? Use your layman English and tell us.
Okay, bond is a type of security
Okay,
which is used by government to issue um how do I put it?
instruments.
It's like an investment, but yes, but it can be tied to maybe 1 year, 2 years with a fixed interest.
All right. Yes, thank you very much. So a bond is a loan made by an investor to a borrower. Yes, it's a loan made by an investor to a borrower. So it is a type of debt instrument. So how it works is that you are lending money to the issuer, and the issuer promises to pay back the loan on a specific date. That is the maturity date. So the issuer also agrees to pay on to pay regular interest. Yes, in most cases, and the interest in form of bond can be coupon. Can be coupon. Coupon. Yes. So The financial market, we said, is divided into different types. Capital
Hello,
markets.
sorry, sorry, sir. Please, coupon. Is it to recoup? You said coupon. Is it to recoup? You know, this is a new top cost. Coupon. Is it to recoup? Or
All right. Anybody to respond to that before I say something? All right. So coupon in finance. In finance. Okay, thank you. In finance, a coupon refers to the interest payment that a bondholder receives from the bond issuer. So coupon is interest, sir. Is interest that you, the bondholder, you receive from the bond issuer. So in some cases, the interest can be on a regular basis, it can be annually, it can be semi-annually. So coupon based on bond is a form of interest that you pay. Instead of saying interest in relation to coupon, in relation to bond market, you say coupon. So coupon refers to the interest payment that a bondholder receives from the bond issuer. So, and one thing you must know is that it can be a fixed income. So, because coupons sometimes are typically fixed amounts paid periodically, yes, during the life of the bond. So, we'll be looking at all these things as we go ahead in our discussion. So, let's get prepared. So, we have money markets, which provide short-term debt financing and investment. So, in money markets, the period of investments is usually between 12 months. Yes, between 12 months. That is money markets. And we have commodity market. These are markets that facilitate trading of commodities such as oil, metals, agricultural products, and the rest. Then derivative market. These are markets that provide instruments for the management of financial risk. Financial risks such as options, future contracts. So this derivative instrument is a way of guiding against certain risks, that might tend to occur in the future. So these derivative market is a financial market where people buy and sell financial contracts. Take note, contracts whose value is based on an underlying asset. That is derivative. So the derivatives are financial instruments whose values come from something else, such as stocks, bonds, commodities. So these are derivative instruments, and the common types of derivative instruments, we can have things like futures. What do we mean by futures? Future is agreement to buy or sell an asset at a set price on the future date. That is futures. You can have still under derivative market, you can have what we call options. Options. In that derivative market, you have an option to choose between two certain things. So the option is the right to buy or sell an asset in the future. That is options. You can either buy or sell the asset in the future. Still under derivative instrument, you can have things like forwards. Forwards. And when you talk about forwards, you're talking about customized future contracts between two parties. Yes, a defined contract that will be executed in the future, but between two parties. And still under derivative market, you have things like swaps. All these will be discussed under foreign exchange risk. Yes, as a topic. Swaps. Swaps involve agreements to exchange cash flows. For example, interest rate swaps. So also the financial market, as part of the components of financial market, we have insurance market. And what does insurance do? They facilitate the redistribution of various risks. They spread risk. And what did you get, or what did you pay as an what do you get in return as an insurance? So sorry. Somebody's trying to reach out to me. So that is why my network has. So can somebody briefly talk about insurance business? Anybody? Yes, these are businesses that happens around us. So speak to it. Speak to it. Insurance. Anybody? I believe this is not your first time of hearing insurance. The word insurance. As a matter of fact, some of you insure your vehicles. So can you tell me something about insurance? Nobody? All right. So
Okay.
all right. You can write down.
Okay. Insurance is a way to manage risk, or it's an institution. We have okay, let me just say it's a way to manage risk, and it's a system or a process of buying protection against maybe your car, household items, cash in transit. Maybe you have a garage. Like I work with an automobile, so we do several insurance, like marine insurance, bringing those automobiles from Japan to Nigeria. So we have to pay marine insurance before those vehicles are shipped from Japan to Nigeria. The vehicles insured for when they are bringing them from the sea, from Japan to, so whatever happened within that period, within that process of bringing it from Japan to Nigeria, the insurance company will pay for those damages, and then we pay for the normal comprehensive insurance we do here for vehicles. That's for the pool vehicles, and for even our personal vehicles. We pay do I think they have comprehensive and third party insurance. And also I think we have like group life assurance. That's for I think there's a percentage from either our gross, or some percentage is taken from our gross to the company will do a completion, like a percentage of our gross or our basic and housing, and pay a certain percentage to the insurance company. In case of any person that died in service, they will pay the family some premium, depending on how much was paid on behalf of that person. I think we have like 2 or 3 person that passed in the past 2 years or 3 years, and then I think one family got like 14 to 15 million. So depending on what is paid as premium, I guess that is.
Yes. Yes. Thank you very much for that practical explanation. So insurance is a financial arrangement that provides protection against financial loss. So it is a contract between an individual and or a business, that is the insured now, and an insurance company. The insurance company is the insurer. You that you are taking up the insurance policy, you are the insured. So the insured, how does it work? You, the insured, you pay a regular fee known as premium. Yes, you pay a regular fee known as premium. So in return, the insurer promises to compensate for specific losses, such as can be in form of fire accidents, depending on the policy you've entered into. Can be it can be theft, it can be illness, the various insurance policy, and the insurer, when any of these policy happens, any of these risks occur, the insurer pays the claim if the insured risk happens. Yes, that is one thing we must know. So, what is premium? in insurance. Premium is the amount paid for insurance coverage. Is the amount paid for insurance coverage, and the policy we talk about is the contract that outlines what is covered and how it should be done. That is a policy. So by the time you, the insured, experience any risks that you guide against, the policy will speak. The policy will speak. That is a document. Hence, you made a claim. That is request made by you, the insured, to get payment for the loss you've suffered. That is insurance. And there's one key thing when you're talking about insurance. There's what we call indemnity. Indemnity. This is a compensation for the actual loss suffered. Yes, indemnity. The actual loss you suffer. What is that word that when you are being compensated, you get indemnity. So there are various forms of insurance. You have life insurance, health insurance, property insurance, and you have auto insurance, you have business and commercial insurance, and so on and so forth. So in the financial market, the insurance market also plays a great role by ensuring that business mitigates against risk. Business don't suffer much risk, but in this part of the world, most people don't value insurance. Yes, they don't see insurance as what they should take, insurance policy as what they should take. They leave everything. Yes. So, but it's good you take insurance. Yes, there are various forms. In most of like in ICANN, there is an insurance cover for every member. Once you pay your subscription within certain period of the month, I think by April, if you've paid your subscription, you have an insurance cover in case anything happens. Yes, there will be a stipulated amount to be given to the member. Mostly is debt. Yes. So also in financial markets, we have foreign exchange markets, and then which facilitates the trading of foreign exchange. Now, what is foreign exchange? Let me ask. What is foreign exchange? Foreign exchange is what?
Foreign exchange is the um like change of one currency to another. Change of currency.
Okay. Yes. So when you talk about foreign exchange, sometimes some people refer to it as forex, FX. So foreign exchange is the process of converting one country's currency into another. And it can also be referred to as a global market where currencies are traded. A global market where currencies are traded. If you walk into any bank, you see dollar to naira rates displayed. You see pounds to naira rates. That is the exchange rate at that particular point in time. It can fluctuate, and when it fluctuates, it can be an advantage to a party and a disadvantage to a party. Now, when the value of naira depreciates, the value of US dollar will appreciate over naira. So when the value of naira appreciates, naira, you use less naira to get dollar. So foreign exchange market is also an important topic that we have to know. As a matter of fact, most times you cannot escape question from this topic, foreign exchange market, because in SFN, there is no diet that they will always test questions on hedging, on foreign exchange. But when you know the trick, the technique, you see it as a walkover. So we believe God to grant us understanding, to be able to understand this very well, because it's a key topic that you have to have good mastery of foreign exchange markets. Under this foreign exchange market, foreign exchange rates, we'll be talking about those options, futures, swaps, and the rest of it. So when it comes to that point, we'll talk more on them. So they also make up the financial market. The makeup of the financial market. So we have primary and secondary markets. Primary and secondary market. The primary market is a market where companies and governments raise capital funds. Yes, so it is a market where new equity or bonds are issued. is a market where new equity or bonds are issued. That is the primary market for you. So companies that are in need of funds may raise funds by borrowing money or by issuing equity. Now, when we talk about issuing equity, what do we refer to? You can call for investors. You can issue out shares for those that have interest in your organization to buy certain portions of shares. So government may raise funds by borrowing money. So I would say that economies are said to be efficiently allocated when their financial system allocates capital funds to those users or to those who use those resources in a productive way. So one of the most important functions of the financial system is that it ensures that only the best projects obtain the scarce capital funds. That is where I was talking about you being able to advise the organization on how best to use the scarce resources, the scarce capital fund. How best should we use? That is where sometimes the issue of make or buy decision comes in. So the funds available from savers should be allocated to the most productive uses. So based on my slide, I said the primary market is when new securities are issued. It serves as a direct link between funds to flow to their more fresh capital. That is the primary market. So who can talk about the secondary market in your own word? Even though you are seeing it, but speak to it in your own way. The secondary market is what? Anybody? All right. So the secondary market, this is a market where existing shareholders or bondholders sell already existing shares or bonds. Unlike the primary market where new securities are traded. In secondary markets, existing shares or bonds are traded in secondary market. So it is a market where the investors sell securities to other investors. So the secondary market can be organized in the exchange or be traded through a financial intermediary. That is, the transaction can take place over the counter. That is over the counter. So the key point is this: the primary market is a market where new securities are traded. Secondary market is a market where existing securities are traded. Yes, Madam Victoria.
Okay, I wanted to ask that. For that, I just want to understand better. That secondary security market, is it
Yeah.
where maybe I bought a shares from MTN and I decide to sell
Very
the
well.
shares? That's the secondary market.
Yes, ma'am.
Okay.
So a secondary market is a financial market where existing financial securities like stocks and bonds are bought and sold. That is why you have brokers. So by the time you have a share and you want to give it out, you visit the stockbrokers. So in return, they get a fee known as brokerage, So where you have existing shares in Dangote and you want to give it out, transfer it to someone else, you quickly run to these brokers, stockbrokers, and they'll find a way for you to dispose them. So that is the secondary market. And also, still under the secondary market, secondary market benefits investors by diversification, that is allowing investments across different securities, and it helps to reduce risk. So that is one of the benefits of secondary market. You can invest in different securities, you diversify your investment to guide against any form of risk that might want to befall any business in the economy. By the time you are into agriculture and you are also into manufacturing of food products or manufacturing of baby products, by the time inflation or certain economic factors is militating against the agricultural sector, you should be doing well in the production of baby products. So that is the essence of diversification. And it also, in secondary market, part of the benefit is risk shifting. It offers varied securities with different risk and return profiles. For example, secured loan stock and equities. I earlier mentioned that equities have higher risk, unlike debt. Debt has lower risk because by the time we move further, there's what we call tax shield, tax savings on debt. So in secondary market, there are different risks and various return profiles, and this is also a benefit that a participant in the secondary market can benefit from. Hedging, that is a benefit that enables investors to protect against risks like currency or interest rate changes by entering or offsetting contracts. That is the word hedging. That is hedging is a risk management strategy that is used to protect against potential financial loss that might be caused by price changes or interest rates changes. It can also be caused by exchange rate changes or other uncertainties. That is hedging. It's also a topic on its own. And we have arbitrage. This involves exploiting price difference between markets to earn risk-free profits. So, anybody to talk more about this arbitrage? If this is not your first time of hearing it, arbitrage. So, arbitrage, let me add value to it. I will say arbitrage is the practice of buying an asset in one market at a lower price and simultaneously selling it in another market at a higher price to make a risk-free profit.
Can I give a practical example?
Yes, very well.
So I work in an FX company.
Yes.
We sometimes we buy funds from maybe one FX company. Let me not call names.
Yes.
One FX company, and then want to sell it to another FX company or an individual. So maybe we'll buy at 15.20 and then want to sell at 15.30. We
Okay.
are not going to keep stock. We're just buying from this person and then locking it to this person or two
Yeah.
or more people. We
Yeah.
just like lock it like that, and then we take our 10 naira spread
Profit.
trade.
Yes, right. Yes. Yes, that is the word. So thank you for
Not
that.
yet understood.
That's it understood, sir. Okay.
Arbitrage.
Madam Chidima, can you come again? It's very clear. But sir, let me just define the arbitrage. Then she'll come up with that explanation again. Arbitrage is you buying an asset in one market at a lower price. You bought an asset in Aba at a lower price, looking for a market in Lagos that you go and sell it at a higher price. So all you are doing is to see how you manage the risk. Is to see how you make a risk-free profit. So the essence of this is for you or for an organization to take advantages of price differences for the same asset across different markets. So one thing with arbitrage is that it involves no risk if done correctly. But if you don't do it right, you might experience certain issues. Yes. So, Madam Chidima, can you explain that again?
So I said I work in a foreign exchange company.
Yes.
So sometimes we buy currency. Let's use USD for example
Yes.
from one seller, and we have an already available market, a buyer. So
Yes.
let's say the seller is offering at 15.20, that's 1,520 for
Yes.
a dollar. and
Yeah.
we see a buyer, a willing buyer at 15.30, we have 10 naira spread. So we don't
Yeah.
keep stock. We are not keeping stock because of the risk. The market is volatile. So we'll buy and then we'll transfer to the ready buyers
Yes.
immediately so that there is no risk involved. And we do
Yeah.
that to avoid the market moving.
Yes. Yes. Thank you very much for that. I think it's clear now.
Yeah,
Yes.
very clear. Very clear.
Mm, yes. We have to move fast. Yeah. We have the issue of money markets likewise. Money market. What happens in money markets? Money markets. What is the core aim in money market? What are we trying to achieve in money markets? In money markets, I would say these are markets where short-term financial instruments such as treasury bills, derivatives, as we mentioned, or bankers' acceptance documents, bankers' acceptances, or I'll also say commercial papers, is a market where short-term financial instruments, when we talk about short times, they are investments within a year. So they are investments that mature in a year, within a year or less than a year. So in these markets, financial instruments that will mature within a year are traded. So money market securities are generally highly liquid. When you talk about liquidity, what do we mean? Volatile. It can easily change hands. Yes, highly liquid and have low risk of default. That is money market. Money market. So based on this slide, I said it's the money market is a network of interconnected markets dealing in short-term funds and financial instruments, typically with maturities of 1 year or less. So transactions are conducted primarily over the phone or online. Yes, you might not need to have a physical presence there. You can transact on your laptop and transact on your phone. The market has moved from being physical to being intrinsic, yes, to being virtual, to being a physical location. Yes. So rather than being a single unified market, it consists of various linked segments such as interbank lending, treasury bills, commercial paper, which interact closely. Let me stop at this point. What is commercial paper? You know, what is commercial paper? So that you not just be seeing some of these things and be saying, what are all these terminologies? When you talk about commercial paper, what do you refer to? Yes, 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 yes. So in um in the financial palace, there's what we call secured debt and unsecured debt. Yes. So commercial paper is a term, or I would say is a short-term unsecured debt instrument used by large companies to raise funds. That is commercial paper. They use commercial paper to source for funds quickly for their short-term. Sometimes they can salaries, or they can quickly obtain commercial paper to offset their the supplies they receive, or to manage cash flows. To manage cash flows. So one thing with commercial paper is that they are unsecured. What do I mean by unsecured? It means that no collateral is attached based on the issuer's credit worthiness. Yes, the fact that you are credit worthy. I've analyzed your financial statement. I can see that yes, your your retained earnings is sufficient. I can see that in calculating your creditors payment period, debtors collection period, I can see and infer that yes, you are credit worthy. even though we know some organization can do window dressing and make their financial statement look beautiful in the eyes of those that want to give them, issue money to them. But it is expected that even as auditors, you vet financial statements, you should give a free and fair opinion about that financial statement so that when organizations are taking those financial statements as part of the document to be used, to be assessed by banks to give loan, they will be able to make informed judgments as expected and not be derailed by window dressing in the accounts, by cosmetic accounting in the that have been done in the financial statements. So commercial paper, again, is a short-term unsecured debt instrument issued by large companies to raise funds quickly for short-term financial needs. And most times they are unsecured. Yes, they are unsecured and they mature between or less than a year because transactions in money markets are transactions that take place within a year and not more than a year. So money markets, we said, they are markets where short-term financial instruments such as treasury bills, derivatives, bankers acceptance.
Can I ask a question?
Yes, please.
Sorry, is it the borrower that will give the commercial paper to the lender? I don't understand.
Okay. The commercial paper, yes, is the borrower that gives. Yes, is a policy that says that you issued the commercial paper.
Okay.
Yes, for you to get returns. So the commercial paper is issued by large financial strong companies. You
What's the
understand?
content of the paper? Sorry.
Okay. The content of the paper, of the commercial paper, is stating agreement
Okay.
between the parties, that within social period, I'll be able to recoup or pay back my loan. Yes,
Like
within
an IOU.
yes,
Okay.
yes, like an IOU. Yes, it's a binding agreement. A binding agreement. So it's just like a document making your agreement formal within a short time. So though it may look very simple, it contains some information that protects both the issuer and the investor. So as part of the content of the commercial paper, you have the issuer's name. That is the name of the company issuing the commercial paper. Then what is the face value? That is the amount to be paid to the holder at maturity. You understand? So what is the face value? And also on that commercial paper, you have things like issue price. That is the price at which the commercial paper is sold. And most times is usually below the face value. Still on that commercial paper, you can have issue of discount rate. And you can have maturity dates of the commercial paper. And you can also have the issue dates. These are some of the key components of the commercial paper. And the denomination, it will also be involved, be stated in the commercial paper. Is that fine, please?
Yes, that's okay. That's fine.
So secondary, okay, I've talked about money markets. Somebody should speak to what is it called? Capital markets. Yes. What is capital market? Capital market. If one is short term, which one is long term? Yes, capital market is what?
Capital
Yeah.
market is for long time. Actually, we can see it on the screen.
Okay, I speak to it.
Look, I think I don't know because there's this a mail that was circulated. I guess it's a public because I received that mail saying that there's a bond for 5 years for 27% interest rate. I don't know if that relates to this.
Okay, although I've not seen that mail. So, Madam Nobu, you want to speak to capital markets? Okay, so capital market is a market where long-term instruments such as bonds and equities are traded. So companies generally finance their operation in the capital markets, but some also finance a portion of their operation by issuing short-term securities. Short-term securities. So in capital markets, you can source for fund to finance your business. So in capital markets is a financial setting where long-term securities are obtained because it helps connect investors with businesses. It also helps connect investors with government for long-term projects. So one thing with capital market is that it has a long-term perspective because it deals with security that have maturities longer than a year. That is capital markets. And what are those that operate in these capital markets? Companies can operate there, governments can operate, financial institutions operate, investors go there to source for money and the rest of it. And the instruments include bonds, debentures, and other long-term instruments. Yes, other long-term instruments that an organization might require to run its business. So that is capital markets for us. And so still on the issue of capital markets, we have international capital markets because the syllabus says that where is it? That we should also evaluate capital markets internationally, international capital markets. So an international financial market exists where domestic funds are supplied to a foreign user or foreign funds are supplied to a domestic user. So the currencies used need to be those of either the lender or the borrower. So when you talk about international capital markets, the key players in international capital markets are the euro market and foreign bond market. So in international markets, it is referred to as the euro market. It does not mean that the currency used there is euro. So, but it's a general name used to describe that market. The general name used to describe the market. So international capital market refers to a market where currency deposits are placed in banks located outside the currency's home country. Now, if you place naira in euro market, if you invest in euro market, what you're doing is international capital markets. This is a market that involves global network of financial institutions, the collections of financial institutions and investors that trade long-term financial assets across national borders. That is, you can have an investment in London. Yes, what you're doing is international capital markets. You can source for fund from that region. That is what you're engaging in is international capital market. Instead of going to the Nigerian Stock Exchange to source for such funds locally, you move beyond the shores of your country. Yes, we have some international organizations that can easily have certain compliance that suits the requirements to operate in these markets. There are certain international organizations that operate in various countries And once they prepare their group accounts, and they can easily meet up with criteria to invest in international capital markets. So these international capital markets involve cross-border investment. That is, investors from one country buy securities issued in another country. And one of the focus of international capital market is that it has it is long-term in nature. That is, it involves instruments whose maturities are more than a year. A year. So that is international capital market. Yes. So some of these things are what we can do well to read. Yes, can read. Now another key point is stock market. I'll need somebody to speak to this. What is stock market? Stock market. Stock market. What does it entail? When we talk about stock, what are we referring to?
Okay, I think stock market is the category of the capital market that only trade in shares.
Very good. Yes, that is stock market. The stock market is a marketplace where shares of publicly traded companies are bought and sold. That is the stock market. So what it does is that it allows companies to raise capital and gives investors the opportunity to earn returns. That is the stock market. And what is being traded there is shares, otherwise referred to as stocks. So it's a portion of your ownership in an organization. That share is your interest in an organization. You know, we have various forms of shareholders, ordinary shareholders, preference shareholders, and the rest. So it's a market where buyers and sellers, that is investors, trade their shares through stock exchange. And one key feature of this stock market is that it involves public companies. That is only companies listed on the Nigerian Stock Exchange. Now, let me use Nigeria as an example. Can have their stocks traded. You know, we have some public listed companies. Yes, by the time you begin to watch business news, you get acquainted with some of these terms. So please try and read business news, business articles. They are very important because I can we now test current issues, even things that are not in your study pack. They will test current issues, things beyond your in your study pack. So you must pay attention to the happenings around your economy so that to get better. Now, when we talk about corporate bond, what do we refer to? Corporate bonds. Corporate bonds. Anybody to help? Corporate bonds. Yes. It shows you didn't read through the slide. Though this is not the slide I wanted to display. I wanted to display this slide reproduced using Canva so that it will add value to the presentation. But I didn't get to do that on time. So what is corporate bonds? Anybody?
Okay, let me just use a layman. Bond. We as we just discussed about bond is a debt instrument, and then corporate could be a corporation or businesses issuing bonds in order to raise finance or financing a variety of reasons or to finance a project or something.
Yes, thank you very much. That is it. So corporate bonds are debt securities issued by companies to raise money. And how does it work? When you buy a corporate bond, what are you doing? You are lending money to the company. You are lending money to the company, and in return, the company will agree to pay you interest. And it can also It will agree to pay you interest and return your principal on a specific maturity date. So it involves you lending money to a company in return for you to get interest, likewise your principal. So some organization in their bid to get finance to run their businesses, they can decide to source for corporate bond. To source for corporate bond. The corporate bond market is where companies raise long-term funds, issuing bonds to investors. Bonds are debt instruments. When investors buy them, they are effectively lending money to the company in exchange for periodic interest payments and repayments at maturity. So that is corporate bond. The corporate bond, the maturity period can lapse till like 30 years. Yes. And one thing with corporate bond, you the issuer, you can either be a private or a public traded company. So that is one thing with corporate bonds. Please let's take notes of some of these words. We'll be doing some calculation that involve bonds. That involve bonds. So the theory is important. The theory is important. The role of the stock market is to what? Why is the stock market existing? Is to facilitate trade in stocks such as issued shares of public companies. Yes, I believe some of you have shares in certain companies. Yes, there was a time that investment in shares in stock was the order of the day until a certain period where there was a decline in 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 the shares investment. So the role of stock markets is to facilitate trade in stocks such as issued shares of public companies, corporate bonds, government bonds, local authority loans. Yes, when we talk about government bond, what do we refer to? Government bonds. Yes.
There are also debt instruments issued by the government to financing a project or a I think in financing a project, let me stick at that. Or at a fixed rate, it can also be it's for a long period of time.
Yes, that is very correct. So government bonds are long-term debt securities issued by a national government to raise money for public spending, for public infrastructure, or to support a budget. You know, sometimes we make budgets in our country, but we don't have the finance to run that budget. So we run to borrowing as a means to finance that budget. So when
Sorry, can government bonds be issued because maybe there's too much money in circulation? They want to mop out money from the populace. Could that
yeah,
be a reason? Okay.
it can be a measure to control the circulation of excess money in the economy. Yes, government can give out their bonds, yes, to source to reduce the circulation of income of money in the economy. It's also a measure when there's too much money chasing few goods in the economy. The government can decide to issue bonds so that those money in excess circulation will be collected. Yes, it's a very good way of controlling money in circulation. Yes, so it's a long-term debt securities that involve organizing on countries, yes, or governments raising money to spend on public infrastructure or to support their budget. So when you buy a government bond, you are lending money to the government. Yes, when you are buying government bond, what you are doing, you are giving government that excess money in your hand, you are giving it to the government. So in a way, as what you've said, it can be used to control the circular flow of income in the economy. So that is government bond for us. That is government bond. So as financial managers, you need to know most of these things, most of these things. So as the role of the stock market is also is to facilitate trade in stocks such as allocating capital to industries, determine a fair price for the asset traded, and to also smoothing price fluctuations Yes, when we talk about smoothing price fluctuation, how does this what how does this happen? Yes, in relation to stock market. How does this happen? Any idea? Smoothing price fluctuation. These are efforts or strategies that are used to reduce or to stabilize sudden changes in price of goods. That is from the word smoothing. Now, there are some keywords in the study test I forwarded to us, the Kaplan material, which conforms with this syllabus, ICANN syllabus. Everything in the ICANN syllabus you can read from that book. So there are some keywords. This word, smoothing price fluctuation, is a word that they can easily bring forth and ask you to explain. So when you talk about smoothing price fluctuation, this refers to effort or strategies that is used to reduce or stabilize changes in price of goods. It can also be to stabilize changes in the price of services. It can also be ways or strategies to stabilize financial assets. Yes. So it is very important because price fluctuation can cause uncertainty for producers. When price begins to fluctuate, you might not know what to do part time. But when there is stability in price, you can easily make decisions that will result into you making profit. So price fluctuation can cause uncertainty to consumers, even to investors, even to government. So there is need for smoothing pricing, which involve strategies that can be put in place to stabilize changes in price of goods frequently. So that is one thing with smoothing price fluctuation. They can just go and pick one word and relate it with a case study and tell you to explain certain things in relation to that. So these are the role of stock markets. I believe we are following. Oh my gosh, this is talking, talking, talking.
We are following.
So still the syllabus expects us to talk about the impact of technology on the changing role of financial markets and institutions. Yes, I need people to speak to this now. Yes, can technology how can technology impact the role of financial markets and institution? Yes, this is a very practical thing that you should be able to speak about. Yes, in your own way. How do you feel technology?
Hmm. Technology has played a huge role in the financial sector. Before, okay, when you say someone is sending you money, first you have to go to the bank, pay in, before they treat the check and all of that. But now, money can change hand in nanoseconds, and people get funds. It's more efficient. Digital platforms have emerged. Look at the likes of Money Point. Once you do a transaction, you just hear quick, quick, ping, that's arrived. So it's so efficient now that it's mind blowing. So the digital platform, technology have done a lot of things in the financial sector, and I know that in the next in years to come, it will be better and more even efficient and reformed.
Yes. Thank you for that. So the impact of technology on the changing role of financial markets and institution. Yes, we must say that technology has really helped in transforming the financial industries. It has helped in reshaping how financial services are delivered. And I will also add that technology as a role in financial services has also helped to manage, to see how we manage and consume goods and services. So it has changed the role of financial professionals. Yes, that is why ICANN is wanting you to be a digital accountant. Yes, yes, a digital accountant. It's not worth hearing when you say you're an accountant and you can't use basic Excel functions, yes, it's not good, because most of your work involve modeling, financial modeling. Yes, by the time you're trying to get your gross profit and you input your formulas, you formularize your sheet, and automatically the result comes. So that is what um, I can want us to do. That if the workplace requires technology, the examination process likewise should be in form of technology. So the impact of technology on the changing role of financial market and institution is that it has really helped in a great number of ways to change the way businesses are carried out. It has helped in reshaping our financial concept, yes, and it has helped business in a number of ways. But we must not overlook the risk associated with it. I have someone, because of his experience with online transactions, he does not do any transfer using mobile apps. Yes, because he had certain unpleasant experience. So he prefer moving to the bank to do certain transactions. So we must recognize that there are certain risks and threats associated with the technology. The issue of cybercrime is a very important factor. Some people have had experience of their money being wiped off from their accounts by them pressing just a code, a code prompt up. Yeah. So the fact that technology is good, you must recognize the risk associated with it likewise. So when you have served with a question in form of this, haven't highlight the pros, yes, of technology on the changing role of financial markets. You also give some cons, some constraints in relation to information technology on the changing role of business. So with technology, we have automation and efficiency, because routine tasks like data entry, reconciliations, report generation are now automated. Now, using certain key accounting software like um, like Sage and the rest of them, as you do your transaction, at the back end, your financial statement is being formulated either monthly, quarterly. As you do your transaction, at the back end, your financial statement is being arranged, reconciliation is being done likewise. So we must understand that the use of artificial intelligence likewise and then robotic process can speed up operations and reduce human error. Now, I visited a bank, yes, the first bank. You don't need to go to the cashier to withdraw your money. You just speak to the machine, press some buttons on the machine, and you get you even deposit. You know, ATM give you money, but this machine can enable you to deposit your fund without going to the teller. So these are the impacts of technology on how we do our financial services, because as professionals, we are expected to focus more on strategic analysis and decision making rather than manual tasks. Yes, if your role at your workplace entails you inputting data, try to use Excel to input data. Yes, you discover so many accountants, so many business personnel don't have certain basic knowledge of this. It's not too late to learn. Yes, you can at least learn to input figures using Excel, learn to do summation, learn to do divide, just create information for yourself and practice. Yes. So technology has helped financial services, has moved financial services from where it used to be to where it is presently. And it will keep improving day in, day out. Some people are at the back end thinking of on how to improve technology, on how to improve technology. So before the year runs out, we have another technology that will be on trend again. So those ones are at the back end brainstorming. How should we do this? How should we improve on this? So technology is key So the role of money markets in providing short-term liquidity. What is the role of money markets in the light of companies? For many companies, bank borrowing is the simplest method of short-term finance. Yes, we define money markets as what? We define money markets as a market where short-term financial instruments are obtained. So for most companies, they can see bank borrowing as an easy way to source for their finance. So loans are usually fixed term and may be for variable or fixed rate and are normally secured. So overdrafts are normally variable rate and unsecured. Now, when we talk about overdrafts, what do we refer to? Overdrafts. Yes, let's speak.
Drafts are like loans. Let's say you have just 5,000 in your account and you want 20,000, you can overdraw. They now
Okay.
give you 20,000. Once that money is back to your account, they debit you.
Okay. Yes. So overdraft is a short-term borrowing facility that is provided by a bank that allows its customer to withdraw more money than is available in the account. Yes. But it's usually have an approved limit. Yes. Depending on the cash inflow into your account. Yes. Depending on your cash inflow, there's always a limit to what you can overdraw. Yes, that is an overdraft. So it's a short-term way of sourcing for fund. Likewise, that is the role of money markets in providing short-term liquidity. Organization can quickly run to the bank and make drawings beyond their balance in their account. And also, factoring can be useful where sales are made to low-risk customers. What is factoring? Yes, I remember in commerce those days, there's this word factoring. Factoring. So when you talk about factoring, you're talking about a financial service where a business sells its account receivable, that is its invoice now, to a third party. That third party is called a factor. It's called a factor, and the invoice is given at a discount in exchange for immediate cash. Factoring. Anybody want to add value to that? You've had experience of factoring in a business. Okay. So, as I've said, when you talk about factoring, it's useful where sales are made to low risk customers, to low risk customers. So the parties involved, the seller and the buyer, and the factor. The factor is the financier, yes, in factoring business. So these are some of the activities, ways in which companies can source for short-term fund from the money markets. And companies with high credit ratings often take advantage of commercial paper markets where they may be able to borrow at lower rates than those by banks. Now, when we talk about, all right, Madam Victoria,
I just want to understand this factoring. Is it
yes,
that
sorry, your network. Hello, we can't hear you. Okay, can you put your question on the chat box? Because we can't hear you. All right. So factoring, let me come back again. That when you talk about factoring, is a situation where a
me as a
business,
business?
okay, sorry, we didn't get you. It's fluctuation in your network. So factoring is a situation where a
I have
business
a business now, and I have an invoice where
okay, we didn't get you clearly. I think your network. Can you
just
come
came
back
by my
again?
and yeah. Yes, I
Oh,
wanted to. I was asking that for that factoring.
yes,
Is it that because I understand that is it like it sales or a transfer of your invoice to another company? Like
yes.
if I have my invoice, I have a
Mhm. All right. The network is
talk is sorry. Can you hear me now?
yes, we can hear you.
Okay, I said if I have my invoice where I have an invoice issued to a customer that is owing me a huge sum, I can transfer that debt and collect the value on that invoice. Is that what factoring is?
Yes, yes, yes. You transferring, giving out your invoice. You giving out your invoice to another party. That your invoice, you're giving it out. What is the essence of you giving it out? Is to get fund in the immediate, in the immediate. So what factoring does is that whereby there is a failure, whereby there is a failure of unpaid invoices, what they do is that customers' debt will be sold to the factor. So what happens with factoring is that when you have an invoice, that is, you have your invoice, you give your invoice to the factor, and the factor in exchange will give you cash for your immediate need. For your immediate need. So, but you can put your question on the chat box. Let me address it appropriate. If um if you get me clearly, if that is not fine. So in factoring, likewise, I will say that the business bears the risk if the customer fails to pay. That is one thing with factoring. So the factor bears the risk of non-payment, and when you bear the risk, you pay higher fee. That is one thing with factoring. So it's time to read more on that. So the role of money market in providing short funds, still on the roles, the banks. Banks participate in interbank markets, either lending to other banks or borrowing from them. Yes, banks do borrow too. Yes, and they lend to other banks. So this is a very important source of funds to banks. For example, the London Interbank Offered Rate, known as LIBOR. Yes, in your studies, you'll be using this word. You'll be seeing this word, LIBOR. They might not be writing it in full, but you should know the meaning. London Interbank Offered Rate. So it's now used instead of basic rates to determine interest payable on sometimes types of companies borrowing. So when we talk about LIBOR, when banks borrow from each other, when banks borrow from each other, there is a benchmark interest rate that is globally used by banks. Yes, so the LIBOR, it stands for interbank offered rate, and it's a benchmark interest rate that major global banks use to lend money to each other in the short term. Yes, that is the rate they use. That is the rate they use. So for you to lend to each other as 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 bankers, yes, yes. Those I recall that the definition of bank is different from the way we use it. Yes. So banks can lend to each other at a rate known as what? The London Interbank Offered Rate. It's a standard is an industry average that is used by banks to lend to each other. That is how banks gets formed from each other. And the role of money markets in local authorities obtain their borrowing requirements from central governments, money markets, stock exchange, from advertising for loans from the general public. So all these are ways in which money markets helps finance institutions to to source for loans. Source for loans. Yes, letter of credit. What is letter of credit? Letter of credit. Anybody
Let
to
me
speak
try.
to?
Okay, because we do this when we want to get a product um from abroad. So there's this letter we get from the bank. I think it's been issued to the I can't remember, I'm trying to place it. It's been issued to the bank
Letter of credit.
saying that they can I can't remember. Yes. So it's like a legal tender that is acceptable to release the product or something.
Yes. So a letter of credit is a written guarantee from a bank that's that I would say that promises to pay a seller on behalf of a buyer. Is that what you do?
That's what we do.
Yes. So is a surety. Yes, that I'm standing in is a letter written guaranteeing that the seller will act on behalf of the seller. So a letter of credit is a written guarantee from a bank that promises to pay a seller on behalf of a buyer. So as a banker, and I'm accepting the risk on behalf of the buyer to pay the seller by issuing a letter of credit. So this happens provided that the seller meets specific terms and conditions. So there are various terms and conditions that must be met, and most times it it is used in shipping documents. Yes, in shipping documents, just as she has made it clear. So that is letter of credit. So there are various financial terms that are involved when you work in financial houses or in organizations that do practical things that as a finance person you should do. So comparison of money markets and capital markets is also part of the syllabus, that we should compare and contrast money markets and capital markets. So I will leave this to you. And if you've not talked in this class, you can do well to participate by telling us what are the differences, the similarities between money markets and capital markets operations. Yes, you can speak to that.
Money market is where short-term instruments are traded, whereas capital markets are where long-term instruments are being traded.
All right, fine. Yes, somebody else. Yes, 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 yes. We've been talking about money markets and capital markets over time. What are the distinctions you observe from our discussion? Everybody, there are certain distinctions you should observe. Now, in money markets, short-term funds is what we obtain in money markets. In capital markets, we obtain what? Long-term funds. And what are those instruments traded in money markets? We have things like treasury bills, we have things like commercial papers, we have things like certificates of deposits. While in capital markets, we do what? We trade on stocks, bonds, debentures. So these are some difference we can observe. And who are the participators in money market? Who are those in money market, operate in money market? From our discussion, you discover that central bank, commercial banks are those that operate in money markets mostly, while in capital markets, investors, companies, governments, stockbrokers are those that operate in capital markets. And one thing we must know, the purpose of money markets is to meet short-term liquidity needs, while the purpose of the capital market is to raise what? Long-term capital, to raise long-term capital. So all these are some of the things you can think about, and even more about the comparison of capital markets and money markets. There is a calculation I presented in this. Yes, yes. So types of discount instruments. Let's see. The role of principal money market instruments. Yes, is part of the syllabus that evaluate the role of principal money market instruments, including discount instruments and derivative products. So when we talk about discount instruments, what do we refer to? Any idea? Discount instruments. Discount instruments. You can see from the screen that there are instruments. Discount instruments are financial tools used to raise funds by issuing bills at a price lower than their face value. That is, this discount instrument is a type of financial security that is sold at a price lower than its face value. Another word for face value is what? Par value. Par value. If the face value is 1 naira, when you are selling below the face value, it means you are selling at a discount of, let's say, 50 kobo, 70 kobo. But when you're selling at a premium, you are selling above the face value. If you recall your issue of shares calculation in financial accounting. So a discount instrument is a type of instrument used for financial security, which is sold below its face value. The face value of a security can be 1 million. When you are selling at a discount, you're selling below the face value. The face value. So one thing we must know is that the difference between the purchase price and the maturity value will represent the investor's return or interest. So based on what I put on the screen, I said discount instruments are financial tools used to raise funds by issuing bills at a price lower than their face value. So when these bills mature, they are redeemed at their full value, and the difference represents investors' returns. Investors' returns. So this is discount instruments, and we have types of discount instruments. What are they? Treasury bills. So it is issued by government through central banks, usually with maturities of 1 or 3 months. So they are considered very low risk investments.
Sorry, sir. What is spot interest?
You said
What is spot interest rate?
spot interest rate.
Yes.
Okay, fine. Spot interest rate is the interest rate as at the time a transaction is taking place. At the immediate. So spot interest rate is the interest rate for lending or borrowing money today, now, on the spot for a specific period. So it is the current rate applied to, it can be applied to a zero coupon bond maturing at a future date. But in simple terms, spot interest rate is the rate of interest that you want to lend or you want to borrow money at the immediate, at now, as at today. That is on the spot. That is spot interest rate. Is that fine?
sir.
So we have types of discount instrument, treasury bills, we have commercial papers, we have commercial bills, bankers acceptance. Can anybody speak to any of these? What do you understand? So that it won't just look as if it's a mirage. What do you understand by treasury bills, commercial paper, bankers acceptance? Though we've talked about some of these, but can anybody speak to this? Let me get your understanding about them. Yes, yes, yes. Let's talk as we begin to draw up, conclude the class now. Yes. Chidima, are you there? Nobody wants to talk.
Yeah.
You know, you need to know some of these terminologies. Yes. So
Okay,
what's
commercial paper. Because I know that there are some investments that we do. So we do commercial papers as those are part of the investment and treasury bills that we invest in our finance team. So I think it's like a promissory note to pay a fixed rate of interest and it's unsecured, I guess.
very well? It's not secured. Yes. Commercial paper is an unsecured short-term debt instrument. Yes. It's not secured. So it is issued by large credit-worthy companies to raise funds for short-term financial obligations. Yeah, somebody else should speak to another one. Yes, these are practical.
Treasury bills are short-term loans that are issued by the government to the public.
Okay. Yes, they are short-term loans or short-term debt instruments
Short-term debt instruments
issued
that
by the
is
government.
issued by the government.
For example, the Central Bank of Nigeria to raise money for short-term public spending needs. Yes, treasury bills. And most times they are risk-free. You know, there's what we call government security. Government security most times are risk-free. When we begin to solve questions on portfolio and you begin to apply your formula, um, risk-free plus beta and the rest of it, then you begin to see situation whereby government bonds are risk-free. Yes. So let's do well to read some of these things, read everything, get used to them. And so I put a simple illustration here, a question in relation to commercial paper. In the slide, I explain how commercial paper works. Please do well to study. Now, illustration of commercial paper that CP company wishes to issue 10 million of commercial paper for 90 days at an implicit interest rate of 5% per annum. Note, this could be expressed as stating that the paper will be issued at a discount of 5%. Determine the issue price. Now, to determine your issue price, the formula is what? Future redemption value divided by 1 plus R multiplied by T over 365. What is T? T is time. What is R? R is the rate, the interest rate. It's defined here. The future value of the redemption is what? It's 10 million, $10 million. Now, the annual interest rate is what? It's 5%. Annual. Take notes. They can tell you for 3 months. It means you divide this value by 3 to get the 3-month value. But interest rates is usually given in a year, for a year. Take notes, please. Interest rate is given for a year. So some question will tell you that for 3 months period, it means you need to get the value of 3 months in the annual interest rate. We get to see questions relating to that. So we have T is the number of days stated in the question. How many days do we have in a year? 365 days. So the question is asking us to do what? Determine the issue price. Determine the issue price that CP company wishes to issue 10 million of commercial paper for 90 days at an implicit interest rate of 5% per annum. Note, this could be expressed as stating that the paper will be issued at a discount. So we're gradually moving to where you need to be writing formulas. Yes. So I'm just bringing this small one. By the time we start with working capital management and we begin to move to economic order quantity just in time, we begin to see more calculations as the day goes by. So to solve this question, I've clearly put everything. The issue price formula is future redemption value divided by 1 plus R multiplied by T divided by 365. You must know this formula. So in the question, the whole variables are defined clearly. The future redemption value is 10 million naira dollar, and the R interest rate is 5%, and the T is the number of days, 90. How many days do we have in a year? 365. All you need to do is to substitute this value into this for you to get the issue price. So as we begin to solve, we move to computations gradually. You will need to embrace writing formulas, yes, and doing more computations. Most of these things, there is a it gives you direction. Financial management question will always give you direction, yes, and you should be able to infer what to do per time from the question. Either you have to use cost of capital, you have to use an annuity formula, you have to use dividend growth model. There will always be a leading. All you need to do in solving financial management question is for you to allow the question to lead you. I'm saying this so that when we begin to solve calculation questions, you allow the question to lead you to what to do. Yes. So I used to tell those SFM people then that don't jump ahead of the question. Allow the question to lead you. Then it will now, when you allow the question to lead you to the right destination. So for tonight, I would like to bring the class to a close so that we continue tomorrow, God's willing. And is there any question?